I'm going to give you 3 examples how to scalp the 20 period moving average, trading the triple Qs. I love scalping the triple Qs. The SPY, I do it a little bit, but more so I like the triple Qs. They move fast, they move violently. You can get some good moves. The thing that I like about the triple Qs is that they have options that expire on Monday, options that expire on Wednesday, options that expire on Friday. So you can get, 0 days to expiration or 1 day until expiration on the triple Qs. Contracts sometimes can be a little bit cheaper than some of the bigger stocks. And the triple Qs will move 50 cents, 40 cents, 80 cents, $1 sometimes. And those contracts will move 20, 25, 35% extremely fast because they're so liquid, meaning that there's so many people trading these options contracts and this stock or this ETF that, the percentages that the premiums move is really, really fast. You don't need to make $1, $2 or $3 on the stock for the contracts to move 20%. This thing can move 30, 40% or 30, 40 cents, and your contracts can be changing in value 20%, 25%, 30%, sometimes 50%. So here's 3 examples, real quick examples using the 20 period moving average, long and short. There was 2 winners, 1 loss, and I'm going to show you the 1 loss because not every time you take the play, it's going to work out, right? So I'm going to show you how to keep the loss small. I'm going to show you how to let the runner run. Okay, so we're going to look at the stock price from 7 o'clock in the morning to 11 o'clock in the morning. We're looking at 3.5 hours, 4 hours worth of chart here. So if we're looking for a reclaim to go long on the triple Qs, we are looking for the stock or the ETF or whatever. We're looking for the triple Qs to be trading under the 20 period moving average. Then we're looking for it to close over the 20 period moving average. And then the next candle to confirm that price. So here where my mouse is at 7:10 in the morning, we get the first close over the 20 period moving average. You can see here, market opens. Where did market open? Market opened right here. Traded up a little bit, closed below. You could have taken this for a short ride here, but there was nothing really there. Did you know that it was going to bounce? No, but I'm just saying there's nothing really here like in the chart to want to trade if you're going long. So you want it to be under the 20 period moving average. Then you get this first close over. So you're going to put a trend line here. Okay. That price is 375.85. Okay. Next candle at 7:15. Confirms that price. You're going to get into this candle. This candle confirmed this top price. First close over the 20. What's your stop? Entry candle's low. Your stop is 375.67. You're only risking 20 cents, 18 cents on the trade. If this candle opens up here, comes up a little bit and then comes all the way back down, you're only losing 18, 20 cents on the trade. Very, very small risk. Okay, enter into this candle here, pushes higher, next candle opens up, pushes higher, next candle comes in, comes all the way down here, which is fine. We already know our stop is here, nothing to be concerned about. Bulls buy it back up, closes at 376.35. Automatically, within 10 minutes time, this price on the ETF, the triple Qs, already moved 50, 60 cents. Your contracts are going to move 15, 20, 25%, just like that. You go as close to in the money as possible or right at the money. Then you get this next push higher all the way up to 376.57. And that from your entry point is about a point. So you made a point on your options contracts. So obviously that's going to correlate a little bit different to the options contracts because we're not trading actual shares. But this contract would have moved 20, 30, 40, 50%. Depending on how deep in the money you went or at the money, whatever your strike price was. If we're scalping, we know we want to be in this trade anywhere from 5 minutes to 30 minutes, okay, max. Because there's going to be ups and there's going to be downs. We want to get in. We want to make, on an ETF, on the triple Qs, I say you want to make 50 cents to $1. On the big boy stocks, let's say, Facebook, Microsoft, AMD, Apple, you're looking for like $1, $2 square. If you're trading the big stocks like Tesla, Amazon, Netflix or something, you're looking for 2, 3, 4 points, in that period of time. If it goes up 2 points, 3 points, think about selling. being that we're trading triple Qs, we're looking for 50-cent move. We're looking for 75-cent move. That's perfect. We get into this candle, and I will always want to take either 50 cents to $1 on the triple Qs or 2 to 3 pushes higher. So if we enter on this candle, okay, enter on this candle, this is 1 push higher, this is 2 pushes higher, this is 3 pushes higher. I would have sold here at the close, regardless if this thing was going to go up. Regardless if this was going to go up another $10, another $5, I don't care. I'm looking for 2 to 3 pushes. This is a scalp. If I entered the price at 375.85, the stock price is now 376.35. My contracts would have moved 20, 30, 40%, depending on what my actual strike price is, or if I chose the weekly or I chose the 0 data expiration. Entered into the trade, 1, 2, 3 pushes higher, 15 minutes. You invest 500 into the stock, right? I don't even know what the options were costing on this today. Let's take a look at what they costed. Triple Qs. What was that price? The price was 375.85 when we were going to enter. 375. Let's take a look at this at the contracts today. 375. Those options contracts were at 144, so I don't know what they actually opened up at, what they opened at. But I mean, you get the point. They could have been anywhere from $60 to $200. I'll just big wide range, right? So let's say you play $500 worth, right? You want to play with $500. $500 would have probably got you 2 or 3 contracts. If those 2 or 3 contracts move 20, 30%, you would have made 50, 60, 70, 80, $100 in 5-10 minutes off that 500. You lay 500 in, 10-15 minutes later, those options contracts move 20, 30%. You're taking out 50, 60, 70, $80 very, very quickly. And the triple Qs will give you 2, 3, 4 plays a day. So here's another example where it fails. Okay. Closes below. You could have shorted the stock here. This is a first close below. If this is a first close below 375.52, you're going to enter into this candle. This is your stop. Stop price is here. As long as the price doesn't break above that and close above that, you're still going to be short. Price does come up, tries to touch, right? Gets close, doesn't, and then completely crumbles. So from your entry price at 375.52, dropped all the way down to 374.41, which is about a point away. 373.89, you get the point. Dropped all the way to a low of 373.46. I mean, that's 2-point move. Your contracts would have been up 50, 60, 70% if you would have went into the money. And here is where the move failed. Here's where the move failed. So in this particular case here, you're looking to get back in long. Let's say you get back in long here. First close above the 20, you get in long at 375.88. Your stop price is going to be 375.67. Confirms that. You get long thinking it's going to go higher. Next price opens up red, comes down, touches your stop. Next candle opens up, closes below your stop. 375.51. You would have lost let's see, 375.67, 375.52, 10, 15, 20 cents. Talking about a cup of coffee. You entered in here, price broke down, didn't confirm, or it confirmed but didn't follow through, broke down below. That's it. You just lost. But you can see how when the move works, you get big runs, right? This is to the long side. You can see, wow, when the stock works, right? Even though it tried to push higher, failed, and came all the way back down. never closed above your stop, so you're still in it. The time that it failed, right, ran up a little bit, closed below your stop, you lose a cup of coffee because you're out so quick. Now, if you let FOMO and anxiety and your emotions get to you and you say, well, I got into the stock, it confirmed, it went over it, even though it dropped below, maybe it's coming back, and you continue to stay in this trade as it goes all the way down, now you're talking about a big loss. This is where you can ruin your account. You can blow up your account because you get set on thinking that you are right. You're not going to be right 100% of the time. You're not even going to be right 50% of the time. But when we're wrong, we want to cut our stop loss here. Okay. We want to cut our stop loss here and not tell ourselves, even though it closed below, that it's going to bounce. Because if it doesn't bounce and you continue to hold, now you're in a world of pain. We don't want to be in a world of pain. The move should have worked here. Okay. This candle should have popped. This candle should have popped. This candle should have popped. It didn't. It failed. So what? We move on. We find another trade. I'm not going to be the guy who gets into the trade here and then when it fails, thinking that it's coming back and then risk losing all of this. Okay. I don't want to risk all of this. I'd rather just cut it here. And if it did bounce here and came back up, so what? So what? Right? We just find another play. We're scalping. We're not looking to marry the stock. I hope that kind of helps.